welcome to you, the audience, in this Iran-related webinar series. Today, we're going to discuss a very important topic, the effect on the global economy, financial markets, oil, and inflation. But before we jump in, we just want to show you a few very important points. The highlight of this, or not the highlight, the reason we're able to do this is because we, Timber Exchange, track the global timber markets. Today, we track more than 500 market signals. We track more than 170 prices in 26 markets. We track qualitative insights as well. For example, from this webinar, we publish reports on the key takeaways of these webinars, and we also publish market forecasts. So really, really important things. And one of our most popular and useful things for the community is, of course, the Global Timber Price Index, where we track the timber prices in 26 markets, the price for a small order versus a big order, and this is, of course, fully certified and done in cooperation with legal counsel. And every time you provide prices to the survey, we donate food from our pocket to those in need. And our goal is to reach 1 million meals during a 12-month period. And here you can see some of our recent work and donations. So thank you to everyone involved. You enable to track the market and create transparency, and you help us to run webinars like these that are very important for the industry and the market as a whole. Now, without further ado, warm welcome to Mr. Allan Eriksen. Hello, sir. How are you today? Where are you joining us from?
Hello. I'm fine. I'm joining from Helsinki, Finland. Thanks for having me.
Thank you so much for coming on. We really appreciate it, and it's on such short notice as well.
Okay.
Yes. Mr. Allan, we want to get to know you and United Bankers. Can you please tell us a little bit about yourself and your company?
So my name is Allan Eriksen. I'm the strategist. I'm the chair of the allocation committee here at UB, and we are like a mid-sized asset management company based in Finland. I mean, we have, of course, normal equity and fixed income funds and so forth, but we are specialized in real assets, and that's especially in timberland funds. We are one of the leading timberland fund sort of investors in sort of within Europe. And I suppose the link to your service comes through these timberland funds we have. And UB as a company it's actually the fourth year. It was founded in 1986, and some of the founding members are still working within the group. And we have assets under management of approximately 5 billion euros currently. We used to be a stockbroker in the early days, but nowadays we are mostly asset managers and sort of, like I said, specializing in real assets.
Super interesting. You're certainly the right man to come and educate us and give us the view on what's happening around the world or due to this conflict. So, Mr. Allan, when the strikes in Iran and by Iran began, what was your immediate professional gut reaction, and has the market's response surprised you?
Yeah, it has sort of the actual first reaction when I heard about the sort of the hit to Tehran was that well, this will be very messy. We had these sort of Iraq wars, and we had the Russian thing in Ukraine back in 22 and so forth, and the sort of oil market spiked, and the equity markets and sort of risk markets took a meaningful hit early on, and that was I thought that would be sort of the way forward this time also. But the markets were quite calm the first week. Actually, the first day of trading, of course, the futures were quite low in the morning on Monday. But for example, the US equity market closed on a positive note on the first day. So the market reaction was quite sort of neutral, basically. And of course, the issue is how long will this go on? And to begin with, everybody sort of, I think, expected it to be a like sort of very precise hit and the sort of wipe of the Tehran government, most of them, I mean, would have like sort of ended the sort of war before it started. I think that was the sort of initial reaction from the markets.
Early in 2026, firms like Goldman Sachs were betting on a soft landing. Do you believe that this war makes a global recession inevitable now?
No, it does not make it inevitable, but as I always said, it's like a question of how long this will go on. I mean, currently we sort of, this is the third week going on, and well, people have been speculating about Mr. Trump doing a taco, and the war could end like tomorrow, but I don't think it will end very, very soon. It will drag on for at least a couple of weeks, perhaps months. And if you, for example, look at the sort of oil futures market and sort of the pricing of it, the June contract currently is quite close to $100 a barrel. But then again, the December contract is down to 70. So the future market is telling you that this will go on for a while, but it won't sort of continue for many months. And if that's true, then I mean, we won't see a recession because the dependency of oil in modern sort of Western societies is much lower now than it used to be, for example, in the 70s when we had the oil crisis. But of course, if this sort of drags on and we had the sort of Hormuz will be closed till December, then I suppose we'll see a recession definitely. But I don't think that's the main scenario.
Morgan Stanley have remained bullish on equities. Do you believe the stock market is ignoring the war, or what is happening?
I actually think that it's sort of pricing in the probabilities in a quite sensible way. As I mentioned, in the sort of the early reaction was very like neutral, but then again, the sort of the expected outcome was that the war wouldn't end for many days. I mean, it wouldn't last for many days. But now, as we have the facts and the war is going on, and though the sort of US and Israeli forces have basically crushed the military side of Iran, they still struggle and they still sort of continue to pose a threat towards the Persian Gulf and sort of shipping and the sort of oil production into the infrastructure in the Gulf. So, I mean, this could go on for long. But then again, the sort of basic setup in the world, I mean, when we entered 26, it was very positive because we have global growth has been picking up, and equities, I mean, companies sort of earnings expectations are sort of have been revised upwards lately, and we had in the beginning of the year there was like this anticipation of falling interest rates. And this combination of rates going down and growth being okay and profits growing, that's very, very good for equity markets and for sentiment. And that's why we had a very strong beginning of the year, especially sort of outside of the US. But now if this thing goes on and interest rates will stop actually go down, and in Europe, for example, markets are sort of discounting rising rates. The first rate hike is priced in to happen already this summer, and the second one at sort of basically December this year. So the market is pricing in rate hikes in Europe as a sort of effect of the sort of inflation pressures and so forth. And in the US, where we had like sort of anticipated rate cuts, we still do, but they have been like postponed to end of this year instead of being now sort of in the coming months.
How do higher energy prices fundamentally shift the trajectory of the global economy? Do you have any examples of how far-reaching higher energy prices ripple through industries in ways that we might not expect?
I think the classical example is fertilizers. I mean, fertilizers are made from ammonia, and to produce ammonia, you normally sort of you need nitrogen and you need hydrogen. And the nitrogen you get from air, and the hydrogen you get from natural gas. So natural gas is a sort of very important source in the fertilizer industry. And we already have examples of some sort of factories in India have been sort of scaling down their production because of the price of gas going up. And then if sort of fertilizer prices go up, or like the availability of fertilizer gets like stuck, then of course the crops will be smaller than they would be otherwise. And if crops be smaller, then sort of the price of like wheat and so on will go up, and the price of groceries, I mean, if you buy things in your local shop, they will become more expensive, and you will have inflation. And that's all related to oil, basically, to begin with. But it's sort of the bread you eat has a sort of component of oil prices in it.
That's a very, very good example indeed. I personally didn't expect that example. You mentioned this a bit before. How were you originally expecting the European economy to perform this year, and how has the forecast changed?
Yeah, well, you remember last year we had the election in Germany, and Herr Merz became the chancellor, and they have had this sort of idea of sort of having these sort of very sort of high budget spending on infrastructure, and also like on defense now, as a function of the thing in Ukraine. And that was supposed to have sort of pushed the euro area growth upwards. And the anticipation at the beginning of the year was that the euro area will grow something like 1.2% this year. But I mean, already before this sort of Iran thing, we have had some quite weak data from Europe, especially from Germany. The sort of manufacturing has been sort of disappointing, and so forth. So I suppose there could have been some like revisions downwards on growth already before this incident. And of course now, the longer this sort of thing goes on, the probable it will get that sort of the growth rates, especially in Europe, will get diminished. And as a rule of thumb, there's like if the oil price will stay above 100 for, let's say, a couple of months, let's say until summer, then it could shave off like 0.25% of growth in Europe. And of course, if it goes on much longer, or the price will get much higher, then the effect will of course be bigger.
Very, very interesting. Looking a bit to the west, to the US, do you believe the US economy will remain insulated because of its own energy production, or will the financial shock eventually pull the American consumer as well?
Yeah, it's sort of unlike in the 70s, when the US was a large importer of oil, they actually now are a net exporter of hydrocarbons. So in that sense, on a sort of national level, they are not that much affected by this oil thing. But then, of course, the oil companies own the oil, and for them, higher prices are, of course, benefits, and they will make bigger profits. But then again, like the normal people, the consumers, who make like the private consumption is something close to 70% of US GDP. And these consumers, of course, they buy gasoline and they buy oil. They don't sell it. So they are affected by higher oil prices. And as the price of oil is set on an international basis and not on a local basis in the US only, that will hurt the consumers. And as we know, the consumers in the US are already quite stressed. In sort of unemployment has been going up slowly but steadily. And like the wage growth has been quite weak. So, I mean, this could be quite sort of, it could affect the US quite a lot, actually, though they are like independent on oil as such.
If fuel prices in the US are higher for a longer period, do you believe that this could be the straw that breaks the camel's back finally?
Yeah, I mean, of course, the sort of fuel price as such, but also, as we mentioned, it sort of trickles through the system. If oil is more expensive, then with the lag, quite a few things will get more expensive as a function of the oil price. So as a total, that we sort of restrict consumption on other products, because people will have to use a larger portion of their income to buy gasoline and related products.
When you mention the lag in the supply chain, for example, with fertilizer, Are we speaking 2-3 months lag or up to or longer?
I suppose it's longer. These sort of processes are quite slow. I mean, and that's also like the sort of reason why the equity market has been quite resilient, because if you anticipate that the sort of conflict will be over in 3 months, then basically nothing will happen. But if it goes on for 6 months or for a year, then we're going to have a lot of problems.
In the markets, are you seeing risk premiums rising? If so, where? And if so, are we heading toward a global credit crunch?
Well, there's been sort of quite a lot of chit chat regarding the sort of private debt funds, and to be more specific, the sort of AI effect on software companies has been like the sort of topic. People have been sort of worried that sort of the AI will sort of destroy this sort of software sort of sector as such, and since some of these private debt funds seem to have quite a lot of exposure towards software companies on the debt side, that's why there's been like jitters regarding some funds, and people have been sort of trying to pull out their money from these, and as a function of that, some of the funds have closed, and people have been trying to buy protection from this CDS market and so forth, and that's why we've seen like CDS spreads go up, especially in the high yield sector, but also in investment grade. But my understanding is that there of course might be some funds that have problems with like bad loans, but I don't think it's like a systemic problem currently. It's more like a liquidity problem. People putting money into funds that are supposed to be sort of long-term investments, but then they get scary and try to pull out the money, and then sort of nobody gets the money because the door is too small, so to say.
Is there a risk that Arabic sovereign wealth funds pull their funding, and that has an effect as well?
Yeah, that would be major if sort of some of these sort of really big players would make like some decisions to sort of exit some specific market for some specific reasons. But I don't think that sort of, well, of course I don't know, but my gut feeling is that nothing very, very big will happen in this sense. It's more like people who are not used to having sort of risk investments are faced with these rumors regarding these software companies, and knowing that the funds they hold could have some of these companies sort of invested in.
Okay. In today's high rate environment, is holding physical inventory now a liability? And should CEOs prioritize cash liquidity for agility or hard assets like timberland to hedge currency devaluation?
Well, that's the billion-dollar question, of course. I mean, of course, currencies are two ways. If one currency strengthens, the other one sort of weakens, and vice versa. So if you have a view on your own currency, so you're sort of afraid that your currency is going to weaken, then you can, of course, sort of change the currency and buy the other one that you sort of think will get stronger. But then I think that if you're like in the sort of the production part of the industry, and you sort of make things out of some kind of material, for example, timber, and I suppose the timber and sort of this kind of sort of stocks of material, they are sort of inflation hedge. If there's a lot of inflation as a sort of consequence of this problem, then of course if you have the cash inflation wise, you will lose. But if you have the like real assets, so to say, the timber or the metal or whatever you need to produce whatever you're producing, then you have like a hedge against inflation, I think.
That's very warm and very welcome news for this audience, I'm sure. How long do you believe the Strait of Hormuz can be closed before global financial markets plumbing, if we call it that, starts to break?
Well, that remains to be seen. But I mean, as I sort of hinted before here, I think that a couple of months of closure will not sort of result in any sort of long-term effects. But then the longer it takes, the more probable it gets that we're going to have some real problems in the international way. And I said, if sort of the Strait of Hormuz is still closed at midsummer, then I think it's going to get real ugly. But if it gets open up, more or less open up during the spring, I don't think it will have like a lasting effect. And then it's also good to know that though most of the oil shipped from the Gulf goes, of course, by sea through the Hormuz, and that the amount is something like 20 million barrels a day. But for example, Saudi Arabia has a pipeline that goes to the Red Sea, so they can push out some oil through the Red Sea. And Oman has also a sort of a harbor on the Indian Ocean side of Hormuz. But of course, the capacity of these pipelines is like 1/4 of the shipping quantities that go through Hormuz on a daily basis. So they can't replace the shipping, but they can sort of make it less hurting, so to say.
Talking about Hormuz and Iran, what would a good outcome look like regarding regime change in Iran, and how fast would markets thaw or welcome if that happened?
Well, I think the most positive scenario I can think of is that they will get some kind of regime change within Iran, and that would require some kind of sort of uprising, I think, amongst the normal military, because there is no like sort of a very strong opposition within Iran. Of course, many people are very sort of unhappy with the situation, but to my knowledge, there are not like any sort of freedom fighters who have guns and are prepared to take up the fight against the regime. So I think to get the regime change actually working, we will have to see some parts of the regular army changing sides and taking the people's side against the current regime. And I don't know if it's sort of very, very sort of probable going forward, but that would be the sort of nice reaction, that we have a sort of news headline that the army has sort of gone over to help like the people fight this sort of current regime. And if that would happen, and then of course the US and Israel could help them militarily, then it could, in a couple of weeks, it could be over, and then the market will be very positive after that, I think. But this is like a low probability sort of case, of course.
Yes. And it's very important also that whoever continues the leadership eventually, that they take over a country that is able to function and not the apocalypse.
Yeah.
Because that could have negative consequences on its own.
Yeah. And I also think that if you look at what would be like good outcomes, I think it was a good outcome with a higher probability would be that sort of within the current regime, there would be some kind of change, that there would be less radical people sort of being in charge of the regime, but they would still be in charge of Iran. There would not be like democracy and so forth, but the current regime would be like more flexible and sort of adhere to some of the sort of demands from the West. But you never know.
We will soon be opening for Q&A. So for you, the audience, should be a button further down somewhere called with a question mark or a chat button, where you can send your questions, and I'll be moderating them and asking them to Mr. Allan. And the last question from me to you, Mr. Allan, is with European gas prices increasing again, how does our economic vulnerability here in Europe compare to previous similar crises, and has Europe's supply chain for LNG changed over time?
Yeah, I mean, so the one good thing with the sort of Russia-Ukraine conflict, of course, is that the European dependency on Russian gas has been considerably changed over time. We are still importing gas from Russia. It's something like I think 10 to 15% of the like pipeline gas that comes to Europe, but it used to be like 60-70%. So that has already changed. And to be frank, I mean, we are importing LNG from Qatar, from the Persian Gulf, but that's only like 10% of the LNG in Europe, and the LNG is sort of roughly half of the total gas consumption in Europe. So you could argue that something close to 5% only is the portion of European gas that is sort of sourced from the Gulf. So in that sense, we are not very sort of vulnerable to this gas shock. And you can also see it in the pricing. I mean, back in 22, when the Russian thing started, gas price in Europe, they shot up to like 350 euros per megawatt hour, sort of in gas. Now we are risen only from like 30 plus to 50 euros per megawatt hour. So the sort of the spike, though it in percentage points is of course like almost 100%, like 60 to 100% the change. But I mean, compared to the levels we saw back in 22, we are nowhere near those levels. So in that sense, one can argue that sort of the economic shock to Europe won't be that bad, even in the worst case. But of course, if the sort of conflict drags on and oil prices, generally speaking, go up, that could affect gas prices, regardless of where the gas is sourced from. Now, I think you're on mute.
Now you can hear me.
Yeah.
So to the audience, please submit your questions to Mr. Allan that you want me to ask him. There is a Q&A button down below somewhere in the middle. Submit your questions, things that you are wondering, maybe you don't understand, things you want clarified, and let's learn together. We'll wait for a moment, and in the meantime, I will be making a short announcement. I'm very, very proud to announce that Timber Exchange has now released its own iPhone app recently. So all the data, all the webinars, everything is available inside of the app. And we have a very important barometer, and this might even interest you, Mr. Allan. We have a barometer where we ask 100 plus market leaders that jointly represent 30 million cubic meters of lumber production or softwood sawn timber, approximately 10% of global production. How do you see prices developing in your home market and your primary international markets over the next 3 months? And we do this survey every 2 months. And here you can see the latest result, which was just published today. We published it early because of this webinar. And here we can see now very clearly that currently almost 75% of market participants believe in increasing prices over the next 3 months. 75%, that is a record. If you can see, the last record when it was similar was in March 25. Very important. And with the price survey that we do, we also have some important takeaways. We saw that 71% of products increased in price month on month. We saw that 60% of markets increased in price month on month. And the average change was 1.4% up, and the median change was plus 1.9% up. And that's what we try to do here at Timber Exchange, to give you the quantitative and the qualitative insights. Now, without further ado, let's open the Q&A session. Okay. The first question, Mr. Allan, is what do you believe are the industries that will be benefiting from the current situation? What do you think about the shipping industry, and how is this situation going to affect it?
Well, of course, the sort of energy cost for shipping, of course, goes up, so it's more sort of expensive to sort of operate the ships. But then one could argue that if sort of huge part of this like tanker flotilla is sort of restricted from going to the Gulf, then the companies who were there to make those sort of shipments could of course charge much higher rates for them. But I'm not a shipping expert, but generally speaking, I don't think this is good for shipping as such.
We have a webinar with a very big break bulk company and Maersk on Wednesday, actually. So this is one of the questions which we will be discussing there. And one of the questions that we will be asking is, will there be an imbalance in vessel or container availability as volume gets stuck on one side or the other, potentially, or because the route becomes longer if you have to go around Africa? The next question is about the dollar. How do you believe it will continue performing in the short and long term? Because it's been very volatile recently.
Yeah. So the general consensus has been that the dollar is going to weaken somewhat over time, especially against the euro. And the reason is that sort of the budget deficits, of course, in the US are very high and growing, and the sort of policies of the current regime are quite volatile, and some people have sort of been very upset. You mentioned some of these sort of big investors sort of perhaps trying to sort of diminish their exposure to the US, generally speaking, and that includes the dollar, of course. But then again, in normal sort of situations, when you have like a geopolitical crisis or crisis of this sort we have now, the dollar tends to strengthen because it's like a safe haven currency, or at least it has been a safe haven currency over the years. So yes, I mean, the dollar has now strengthened from 119 to the euro to something like 114, 15. So that's like 3, 4, 5%, something like that. And that's, I think it's quite normal given the sort of things going on. One could argue, though, I think that the sort of strengthening of the dollar being so minimal currently could be a sign of the dollar sort of basically being on a weaker trajectory going forward. But sort of it takes until this crisis gets resolved before you see what actually will happen with the dollar. But then again, of course, if the market has been pricing in 2 or 3 rate cuts this year, and now with the oil situation and the inflation expectations changing, you probably might end up with only 1 cut or probably 0 cuts. And that, of course, will mean higher interest rates in the US dollar, and that as such will, of course, strengthen the dollar, sort of all other equal.
Yes, we live in a very quick news cycle. Venezuela, Greenland, Trump wants to fire, I was about to say Alan Greenspan. That's a very long time ago. I'm blanking on the current name. But what's the latest with that? Has the Fed chair been changed? Will he be changed? And how will that affect the market, do you think?
Mr. Powell, I also said Greenspan almost. Mr. Powell, sort of his sort of mandate will end in May this year anyway. So since the president hasn't been able to fire him, now I suppose he will try to do it before May. And he has sort of, I mean, the new guy, Walsh, he has not been confirmed by the Senate, so it's not sure that he will become the next sort of president or the chair of the FOMC, but it's quite probable that he will. And of course, Mr. President has stated very clearly that he would like to see very much lower interest rates. And the Secretary of the Treasury, Mr. Bessent, has also been very sort of clear on his views. And by the way, Bessent has sort of stated early in the sort of early last years that they would like to see the dollar weakening. They would like to see the oil price going down, and they would like to see interest rates going down, I mean, long interest rates. And what's happening now, due to their own policies, is that oil is going up, the dollar is going up, and interest rates are not going down. So it's quite the opposite.
Could there be a situation if, hypothetically, the conflict continues and does not end, where they actually decide to lower interest rates, and what would happen at the same time as prices rise and interest rates are cut?
Well, that would take some kind of sort of very weak labor market, very weak consumer data, sort of signs of like the growth slowing down considerably. And then, of course, you would have this stagflation scenario where the growth is slowing and inflation is going up, and that's very cumbersome for central bank to cope with. But I suppose my gut feeling is that sort of being sort of forced in such a situation, they would choose to lower rates because of the labor market and the consumption instead of rising rates as a sort of act to fight inflation. Because if this sort of oil thing is a temporary one, then inflation will solve itself going forward. As we saw with the pandemic, I mean, inflation shot up and then it came down basically in 1 or 2 years after that without anybody doing much about it.
The next question is, could fertilizer production in China, Canada increase to compensate?
Yeah,
For
of
example,
course.
India in this case.
Yes, of course, it depends where they get their sort of gas from. Supposing they're making this fertilizer out of natural gas. And so since the gas market is an international market, just like oil, and as I said previously, that despite the US being a net exporter of hydrocarbons, the gasoline price in the US is going up because international price of oil and gas is going up. I suppose the same applies to the gas market. So if natural gas is getting more expensive because of some constraints in the Hormuz and so forth, I suppose it hits everywhere. It's not like it's a local thing in the Persian Gulf or Europe only. I suppose it's in Canada and the US also, if the fertilizer is made out of gas. But I know I'm not a chemist, so I don't know what kind of processes there are to make these fertilizers besides gas.
Then we will invite a chemist to the next webinar.
Yeah, exactly.
No, but it's very, very interesting indeed. And one data point that worries me personally is single-family homes housing starts in the US, which are at a quite low level. And some people have hinted at the accuracy of those starts. So, and that indicator itself is responsible, I don't remember, for 20 or 30 million cubic meters of consumption, that single indicator of consumption of wood, of course. So combining unaffordability, you're deporting all the nice people that are building the homes and trucking the lumber, higher prices for filling your tank and buying bread. Consumption could be even lower. Lumber consumption in the US could be even lower than going forward in 2026. It sounds like.
Yeah, and also, I mean, sort of the US administration has been pushing for lower mortgage yields just to sort of cope with this problem. But as we mentioned, interest rates are currently going up as a result of this thing going on in Iran. So that won't help the sort of housing market in the short term.
Any more questions to Mr. Allan? Mr. Allan, as we wait for a few final questions, do you have any facts that you want to share about the market that you find interesting? Data points.
I mean, the US Fed and the US interest market and the growth outlook and the equity markets, I think there's like some kind of small imbalance in that the market is still pricing in interest rate cuts, while at the same time inflation expectations are going sky high. I mean, 1 to 2 year inflation expectations in the US has risen from 2+% to 3-4+%. And if that sort of continues for a while, I could argue that the Fed is not going to cut at all, unless there's like a sort of consumer like hit to the consumer and like the unemployment going up very rapidly, and then we have the stagflation thing, and that's not a good thing either.
I believe that were all the questions with the audience today. Mr. Allan, thank you so much for coming on the show, sharing your very important insights. We really, really appreciate it. And we hope you enjoyed your time here.
All right.
Thank you very much. And thank you to the audience, and see you very soon, already on Wednesday. Thank you, everybody, and goodbye.
Bye-bye.